Okay, in this recording, I am going to go through Chapter 6, which is about inventory. I like this graph on this page. We're talking now not about a service company like we've been going over for the first 6 weeks of the course. We're talking now about a wholesaler, your company as a wholesaler. You buy from a manufacturer. Let's say the manufacturer manufactures Ralph Lauren shirts, sells them to you, the wholesaler. You turn around and sell them to Macy's or Dillard's. They sell them to the final customer. So remember in this case that your company now is a wholesale company. They're buying inventory and turning around and selling it to make a profit on that inventory. Make sure I didn't miss anything on the first page. Nope, skip that. Okay, this page illustrates the difference between a service company income statement like you saw in the previous chapters, service revenues less expenses. Now in a merchandising company you have some more lines. First of all, you have sales revenue now rather than just service revenues. You have a new item called cost of goods sold, and that gives you gross margin, or it's more often called gross profit actually nowadays. This is an older book. And expenses, and then net income. So you can see how the financial statements are going to start to look different for you. Okay, sales revenue, of course, now will be your credit as opposed to just service revenue. Now sales, when you have sales, there are a couple of other things that you usually have along with that. If you're a female in this class and you're listening to the video, you pretty quickly will recognize that if you have a sale, you're probably going to have a sales return. I jokingly say that all the women in the class go out on Saturday and buy stuff, and then they take it all back on Sunday. Pretty true, actually. So that's a new term, sales returns and allowances. And then sales discounts. When you're in the world of wholesaling versus retail, quite often you will receive a discount for paying your bill early. The manufacturer wants you to pay him as soon as possible so he can manufacture more shirts and make more profit on those. You're going to, on the other side, offer a discount to the retailer like Macy's, try to get them to pay quickly so you can buy more inventory and sell more shirts. So these are both contra accounts, like accumulated depreciation was a contra asset account. Remember how it stayed with depreciation on the balance sheet? These are contra revenue accounts, and they stay with the sales account when you're showing them on an income statement, or at least the ones in this book. Okay, so now recording gross sales. If it's a cash sale, of course, you're going to still use the same rule of cash flow. Cash is coming in, credit to sales. Again, not service, but now sales. Some books say sales revenue. Sales is good enough for me. Or if the customer is charging it, then you're going to say accounts receivable and sales. Okay. Now, something you might encounter is a trade discount. Sometimes manufacturers and wholesalers will offer trade discounts, and those are to high volume customers. You buy so much from them that they sell it to you at a lower price for the volume of business you do. So that is a trade discount. And I'll let you look through the examples. The next type of discount is a sales discount. This is when the company offers you a discount off of what you owe them if you will pay early. Let me go to some of examples on the next page. Here's some common discounts. 210 net 30. Now these are called credit terms. 210 net 30 means if you'll pay within 10 days, you can take a 2% discount. If you don't pay within 10 days, then the whole amount is due in 30 days. This one is if you pay by the end of the month, you get a 2% discount, or else everything is due in 60 days. Okay, so those are some examples, and remember the term credit terms. And here is how credit terms are accounted for. This business sold $2,000 on account, terms 210 net 30. So the debited accounts receivable, if it has terms, that means it's a charge. You don't have terms on cash because, of course, they're paying immediately. Debit accounts receivable, credit sales. Now, when you pay the bill, or the customer pays you, in this case, we're on the other side of the transaction, you have to take their entire receivable off the books, take the whole $2,000 off the books, but they only have to pay you cash of $19.60 because a 2% discount is $40. So you're going to debit sales discount, a debit account, which is contra to this credit up here, but debit sales discounts for $40. All right, sales returns and allowances. Sometimes you might order, or a customer might order, or you may send some shirts to Macy's that aren't the colors that Macy's wanted. You will allow them to return that shirt, those shirts. That's called sales returns and allowances. And you can see how that's handled up above. Yeah, if they've taken a discount, you have to take care of that first. But usually it's just debit sales returns and allowances. And normally it is credit accounts receivable, like down here. Don't even look at that entry. That doesn't happen in any of the current accounting books. This is the one that you're going to see, debit sales returns and allowances. Of course, that's reducing your numbers of sales because somebody is actually returning some. Okay. So this is the entry that you're going to be tested on, the one in the center there. Okay, so now again at the top here you see gross sales, less the discounts, less the returns. These are your net sales. So you had gross sales, but you allowed some returns and some discounts. So net, you only had 262 in sales. Okay. When it comes to inventory, we have another issue we have to deal with, and that is determining the cost of the goods that we sold. Well, you have to be very careful to know how much profit you're making on the goods that you're selling. So we have to talk about cost of goods sold. I don't see anything else in that paragraph. They put a lot of words in these books, I think, to make them bigger. But we're not going to worry about those right now. We're going to skip over this one for right now. We're going to skip over how you calculate it. I'm going to get back to that in a minute. I want to kind of review what's coming in this chapter. There are two ways that you can cost out your inventory and that you can account for it. One is perpetual, one is periodic. Perpetual, you have a merchandise inventory account. And when you sell something, you know exactly what it costs, so you're going to go ahead and put that information into cost of goods sold. Under a periodic system, you don't have an automated inventory system. You don't have a scanner, any of that. And so then you have to deal with things differently. And this book is actually this chapter is really going to focus on the periodic method. All right, let's see. Let's go to the entries first. When you have a periodic inventory system, that is, you don't have an inventory system, you don't have an automated system. When you, the wholesaler, buy from the manufacturer, you're going to debit an expense account called purchases, credit accounts payable. Most all of ours are going to be charged, so don't pay too much attention to the cash entries in here. Now, when it comes time to pay off that bill, if you've gotten a discount, that's going to be called a purchase discount this time. We discussed sales discount back a few minutes ago. You owe $30,000. Take the $30,000 off the books, but you only have to pay $29,400 because you got a discount of 2%. And the other is called purchase discount, and it's a contra to the purchases expense account. So you have another contra account. skip this page. You are not going to have to know any of this stuff. We are not going to deal with that. Just like in sales returns, you're going to have purchase returns. If you return something you bought to the manufacturer, you're going to take it out of the accounts payable because you don't owe them anymore, and you're going to put it in purchase returns and allowances, which again is a contra account. Okay, let's move on. Now, one of the things you have to be careful about in inventory is determining who owns goods when they're in transit. Do they belong to the seller or the buyer? Well, that's going to be determined by this terminology here. FOB shipping point means free on board at shipping point. It says the buyer incurs all transportation costs after the merchandise has been loaded on a railroad car or truck at the point of shipment. Thus, the buyer is responsible for ultimately paying the freight charges. It also means that title to those goods transfer to the buyer the minute it goes on board. Okay, so they have legal title. Even if it's in transit, they're the ones who are going to insure it against fire or damage or theft. So free on board shipping point means that everything belongs to the buyer at the minute it goes on the transportation method. FOB means free on board at destination. Now, in this case, the shipper ships the goods without charge to the buyer. The seller is ultimately responsible for paying the freight charges. So if it's free on board to the destination, it's free on board to the destination for the buyer. That means the seller is paying for shipping. It belongs to them in transit. They are paying for the insurance, etc. Okay. Right, so those are the two. Now, under periodic inventory system, this if you're paying the freight, it's called freight in, not transportation in. This is an older book that we secured because it cut the cost of your book down considerably, and some of the terms are a little bit archaic. But so now it's normally called freight in, and you normally pay for freight with cash or something equivalent to cash. So. If you don't have an inventory system, you put those costs into an account called freight in. Let's see, let's kind of skip that. All right, they're going through some reinforcing problems here. I'm not sure if they're going to actually help you. You can go through, I'm going to go through some problems, and I'll be better able to take you through those than through those little examples. Okay, so what I mentioned is particularly when you're taking a physical inventory, you need to know who owns those things that are in transit. The ones that are in your warehouse are pretty easy to determine, but not necessarily for those that are in transit. Okay, now for determining cost of goods sold, now we're going to go into that. To determine your cost of goods sold, you look at the inventory you had at the beginning of the year. What would have happened was, this is January 2012. January 1, 2011, December 31, December 31, 2011, the company would have taken an actual physical inventory, and determined how much inventory they had. And that's the amount, $24,000 in inventory. During the year, they purchased $167,000 more, but they got discounts of $3,000. They had returns of $8,000, and they paid freight of $10,000. All of these numbers go into an account called, I hope they have it over here. This is known as cost of goods available for sale. Exactly what the term means. Cost of goods that you could possibly sell. You could sell your beginning inventory, and you could sell your net purchases with the transportation expense added in. That's all you could possibly sell. You can't sell what you don't have. So these are the goods you could possibly sell. Now, they're either sold or they aren't. Okay, so the end of the next year, end of December 31, you go out and count your inventory. You had 190,000 you could possibly have sold. You count your inventory, you have 31 that are not sold. So 159 must be sold. That's the cost of the goods that you sold. This is not something that you need to remember for the rest of your life. And as far as getting through this chapter and the test, just keep remembering to go back to this chart. All of the numbers are going to be given to you. You can just plug them in. The important thing is to remember of this goods available for sale is all you could possibly have to sell. And you split it up between what is not sold and what is sold. Cost of goods sold is what is sold. Okay, so that's cost of goods available for sale. Here's another way that you can look at it. Beginning inventory on this side. Your net purchases on this side, including freight, gives you cost of goods available for sale. Go out and count your ending inventory. If that's still there, then you must have only sold 159 of the 190. Okay, so that's a good little chart too to help you try to grasp this concept. Now, here is what a full inventory type company. Now, this is on a retail company. But you can see under operating revenues, now not just revenues, but they've got sales, less the discounts and returns to give you net sales. And then they have this whole calculation of cost of goods sold that we just went through. They've plunked that right into the income statement. You see that 159. And then the next line you see is called gross margin, but it now is more often called gross profit. But you have 262 in revenues, in sales, revenues, net sales, and you have 159 in, that's what that merchandise cost you that you sold. So you have gross profit or gross margin of 103. And now they've made this a little more specialized. Now they have separated selling expenses from administrative expenses, and you get income from operations. Okay, so you see this has become a lot more complicated. This is the accounting approach. You don't see this done in real life, never ever anymore. But this is how they come to those numbers, even if they don't show them all on the returns, even if they're just showing net sales and they're showing cost of goods sold. This is what's behind it. Okay. Okay, let's see. Now, I don't know what page I'm on here. I think it's page 231, but these pages are not laid out like the book. The point is that we are not going to go into analyzing and using financial results. The gross profit margin, we're not doing any of that, so skip that for the chapter. And I just want to go through here quickly. We're not doing the worksheet, not doing that. Back here you will see some illustrations of financial statements, but we will not be doing this worksheet. We'll be doing statements just like we did them in the first part. We will not be doing closing entries, thank goodness. Okay, so I'm limiting the amount that you do. The demonstration problem does actually show you how they go through a whole bunch of transactions. And of course, the demo problems that I do will help you with that too. So this chapter has mainly a lot of new terminology. To get through the problems, go back to the book and mimic exactly what they do. I mean, there's an example in the book for everything that you have to do. Don't sit there and beat yourself up trying to wrangle through it. Go back and look at what they did in the book, do it that way. And if you do that enough times, then you'll know it. I certainly don't expect you to retain all this stuff in either reading through the chapter or listening to me. The only way you're going to retain it is to take the problems out, look in the book and figure out how to do the problems, and then repeat it enough times using your study guides or whatever that it will stick with you enough to get through a time test. Okay, so that's all I'm going to do on this chapter, and I'm going to record the problem solutions separately.